Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, here we go. It's the Investor Coaching Show. A north wind blowing into town. Oh man, I hated that, Evan.
It's a bad day to wear a Hawaiian shirt.
Oh, it really is. What on earth are you doing dressed like that, man? Come on, really? I've got my sweatshirt on, and I'm cold.
When you climb in the garage, you don't realize how chilly it is. Like, holy cow.
Yeah. Summer can't come. Global warming can't come fast enough for me.
Bring it.
I'm really looking forward to it. I could use it a little bit, but okay. So we're not here to talk about the weather. Good way to start a show, though, isn't it? The world of finance and investing, and what an interesting Friday we had. Yeah, okay. So Supreme Court comes in and says you can't do tariffs. Oh yes, you can. Oh no, you can't. Oh yes, you can. And matter of fact, we'll give you one of the justices giving him all kinds of ideas, things that he could do. I thought that was great. My wife just told me that. She says, "Oh yeah, it's like here are all the ways you can get by and do what you want to do." And so there were some people saying, "Hey, this is actually going to be great. It's going to be really good for him. He has a win and blah, blah, blah." And I'm like going, oh, man, here we go. You just got to wonder how that's going to play in the midterms, though, with the way it gets spun.
You do. And, given the message that that we've had for, 30 years now. When did you start the show?
It's 25 years ago.
25 years ago.
Yeah.
It's just more fodder for people.
Sure.
Well, if I think the court's going to do this, I'll put this in this category. If I think, it gives the media tons to talk about, which gives us tons to talk about when they're wrong.
Well, it is. I mean, it's because people feel like they have to respond to the news. I got to do something different.
Right.
I got to make a change. I got to, and reality of it is before. The smaller value stocks took off last year on the international side, and so far this year it's this year too. I mean, even U.S. and we owned it before it happened. Mm-hmm. You just make sure that you have what is going to benefit from what's happening going forward before it goes up, not after, which is unfortunately what so many times people do. There was actually Evan's digging through a stack of stuff, but I actually had a situation where I was talking to somebody this week, and I don't know if I've got it. I'll find it if I've got it in here someplace. It's probably in my stack of junk here someplace. But, I had a conversation with a young guy this week. Yeah, there it is. Yeah, so it was a conversation, and I said to my son, do you think he'd be okay with me talking about, I'm not going to use his name.
Sure.
And, he says, do you think he'd be okay with it? Yeah, go ahead, Dad. Go ahead, talk. It's a friend of my son's, and we got into a conversation, and just a bright, super, super sharp kid. I mean, master's degree, does incredibly well, has a phenomenal career going.
Cool.
And saving. Is putting money away for the future.
Is he single?
And exactly. I mean, yes, he is.
Maybe you should share his
as a matter of fact. All right, we'll have a dating service going here too. Why not? What else can we do as entrepreneurs?
There you go.
So he said, "Hey, can you take a look at what I'm doing?" And he had a Robinhood account.
Yeah. And
I said, "Okay, just kind of share what are your questions?" Yeah. And I thought it would be a good way to start the shows. What is a young guy's questions in his late 20s? Because they're questions that other people have as well, no matter what your age. One of them was saving money for a house. Should I be buying a house? And I said, as a single person. And he lives in a different part of the country. And I said, what's your rent? And the rent it was just shy of about $2,500 a month. I mean, it was for a small place too. I mean, we're talking less than 1,000 square feet in this part of the country.
Yeah.
So we got to talk about, well, what does it cost to buy a house? And he says, in this part of the country? And I said, yeah. And he says, work, because that's where he works. He's got to live there. And you could buy something like a less than 1,000 square foot place for about $500,000.
Okay.
It was literally,
right.
literally that amount of money. And, a lot of places around the country, real estate's gotten kind of ridiculous. And I said, okay, so we take that and you're going to have to borrow most of it, right? So what is your interest going to be on that at today's interest rates? And we figured out based on current interest rates, about $30,000 of interest. And then we figured, okay, and what are the property taxes? Property taxes were about $5,000. Okay. And then I says, okay, now how about the difference in cost of renter's insurance versus homeowner's insurance? Now you got a few $1,000s right there. Yeah. And we just started, and then we started adding up, cost of upkeep, making sure that you have the place, the upkeep taken care of. And, if anything breaks, you got to fix it. And we talked a little bit about that. And just as we got into the conversation, he's like, oh my gosh, between interest. And then we talked about, because whoever you meet, she's not going to like your place. You're going to hate it. And you're going to have to move. So you had commission to buy the place. Right. And we talked about the commission on the buying side. And then we talked about the commission on the sales side. And before long, he's sitting there going, this is crazy. Why would I own right now?
$2,500 is a great deal.
Exactly right. Exactly right. So that was one part of the conversation.
Wow. Okay.
And then we got to talking about not having emergency money. He had his money on the side was in an investment account, a Robinhood investment account, and he's a saver. We got into talking about, do we do a 401k? He goes up to the match on the 401k. He wanted to put extra money aside. Good. His income was too high to deduct the contribution to an IRA. And we talked
good for him.
So yeah, exactly. So and that can be, be one of those things where you look at that and say, hey, do I do something off to the side? Sometimes people should. It might make some sense to do that, where you have a 401k and you have limited choices in your 401k. You don't have the diversification that you would have when you're doing an IRA, because the world's your oyster when it comes to the IRA. If you've gotten past the match, it may be a good idea to do some form of IRA, whether it be a Roth or pre-tax. So we talked a little bit about that. Then I said, okay, show me the account. What do you got? And he said, okay, here it is. And he starts naming investments. And he had a SPDR, S&P 500 ETF, had Apple, an individual stock, Alphabet, NVIDIA, had Joby Aviation, Iron Limited, Paycom Software, Tesla, Invesco QQQ, Invesco S&P 500 equal weighted, Vanguard Total Stock Market ETF, VanEck Morningstar Wide Moat, Vanguard Real Estate, had iShares Russell Top 200 Growth, Motley Fool 100, and he had some gold shares, Round Hill Magnificent 7, Vanguard Total World Stock, and Vanguard FTSE Emerging Markets. So, of course, what's the first thing that I do with them?
Do a intersection.
Yeah.
Stock intersection. Yeah.
After asking the question, what are the rules of investing?
Right.
And, he's like, well, I don't know, buy low, sell high. Good. Okay, excellent. Okay, what else? Diversify, right. What are bonds for? Bonds are there for safety and, those types of things. So we go through that and we do an stock intersection. Yep. And NVIDIA is owned by 10 of those holdings.
I was going to say he's got the Mag 4 plus duplication in almost everything you said except gold.
Yeah,
maybe.
Apple was held by all of them. Tesla was held by all of them.
Wow.
Paycom Software was owned by three of them. And then you had Microsoft was in there, 9 of them. 9 of those holdings had that. Amazon, 10 of them had it. And Meta Platforms, and so on and so forth. So I did that, and he's like, oh my gosh, it's not diversified. I said, perfect, exactly. That's what I wanted you to see. And he's okay. So we got to fix that. And I said, okay, good. But what was the first rule of investing? You said, and he said, well, buy low, sell high. And I said, good, okay, great. When did you get these holdings? And he told me when he got them. And I said, so just year to date. For example, you have the Round Hill Magnificent 7 ETF.
Yeah.
How was the performance versus the standard benchmark? And it was under by about 3%.
I was going to say 5.
Just about 3% for the first month and a half of the year.
Okay.
Okay, so right there you have a relative loss. Even though, and you know that benchmark didn't do so great either. Let's just face it. If you look at the S&P, it's up like less than 1%.
Flat. Oh, yeah, it's almost, yeah.
Yeah, it's a pretty much flat for the year so far, right? Motley Fool, which is interesting because we have quoted those guys as talking about, and sometimes you'll see stuff from them, which is rational.
Yes.
But then you have a fund that they're named, that's named after them, and then you see so much of their material having people stock pick in market time and encouraging people to do that, and it's like talking out of both sides of the mouth.
Yeah.
Which is very frustrating. And that's what I find is frustrating about the industry. I mean, look at mutual fund companies. They'll give you stock picking market timing, but if you want to have a buy and hold investment, you know, that indexes, they'll have that too. And if you want an equal weighted fund, they've got that too.
Right.
And by the way, I described it equal weighted to him. And he says, yeah, I says, you bought that. And he goes, yeah, I saw something that said I should own equal weighted. I said, well, you got rid of the problem of overweighting really huge stocks in an index fund. You know, so those of you who don't know what I'm talking about, if I own an index fund, it has, let's say, one company that is twice the size of another company. You know, if you look at the total value of the company, one's twice the size of the other one, they'll put 2 times as much money in the one that's twice the size. Well, where do I expect more return? I expect more return in smaller companies that got more room to grow, right? But, you know, that appeals to people. They like the idea of just owning those big companies. It just, you know, that familiarity. So what I did is I said, well, it'll take, let's say, the S&P 500, and it'll have 1/500th of your money goes into one stock, another 500th of your money goes into the next one, and the next one, and the next one. I said, think about the implications of this. I said, now you have to run a mutual fund where you're always holding the stocks as best you can in 1/500th amounts.
Yeah.
You know, so literally you have to have, let's say if you got stock A goes up more than stock B. Now I've got to sell some of A and buy more of B to make sure that I don't have too much of my money in one. And it's almost like rebalancing on a daily basis in a way. But
yeah, kind of.
But the problem is this: the expense. Right. You're having to trade all of this stuff. Get rid of this stock, buy this stock, get rid of this stock, buy that stock. And you know, if it's a taxable account, that's even more problematic. Yeah, so you have this triggering of all this expense in there, and the mutual fund industry loves this stuff because where do they make money? Trading stuff. So they love it. So what does that one do? Well, it was under by 2.5% so far, just this year to date, under the benchmark by that much. And, you know, so you look at that and go, oh, gosh, well, I guess that wasn't so great. And then the third fund in there was a Van Eck Morningstar Wide Moat.
Yeah.
And that one, well, it was only under by 0.27% so far this year, but it was under almost by 5% last year.
Wow.
You know, so you look at that and go, wow, over and over again. And the point being that what drew him to buy these particular funds and these particular holdings? And I would submit it was past performance. This is what the investment industry does. And I've been talking about this a lot. You know, I was on Channel 5 this week. And I said, there are a couple ways to run an investment firm. One is to, and you hear this all the time, Evan. This is something, I don't know if you and I have talked about this at all, but I've been saying, it drives me crazy when I hear investment firms go, well, we do better when you do better. And you see these commercials all the time. We do better. And yeah, there's some good stuff there. Yeah, it's good to align the interest of the advisor with the client. But there's two ways to align that interest. One that's not so good for the client. And that, I would submit, is mainly what I see and what I have seen in well over 30 years in this business.
Yeah.
They basically say, if we can increase our assets under management, we do better. No question, the investment firm.
Right.
But how do you increase the assets under management? How do you increase it? Do you increase it by making sure you invest well and grow the portfolios? Or do you do it by attracting new assets for new clients?
Right. Yeah.
It is the latter.
Yeah.
How do you attract new assets from new clients? Show past performance and get people to believe that maybe that performance will continue into the future. Where do we see the flows? And I talked about this on Channel 5. I actually had the data where all the money flowed in late 2024. I had where the money was flowing into mutual funds, the top 10 places that money was flowing into. Guess what it was, Evan? Guess what asset class it was all flowing into?
Oh, large U.S.
Exactly.
I was going to say it wasn't international small value.
That is exactly right. It was not what did best.
Right.
It was all flowing to that area of the market. And that was case in point. If these fund companies and investment managers were really walking the walk and talking the talk, that's not where the money would be all flowing.
Yeah. Two comments on that. One of the reasons we know this so well and are passionate about it is this is what I used to do, 30 years ago.
Sure.
And eventually figured out, hey, this isn't a way to do this of replacing a fund because
you're taught to do.
Tanked, and then I'll put someone in a fund that had a good track. I mean, that's how I was taught.
Yeah,
that's how
it's
pretty
not
much
that
everyone in the industry is taught.
Evan used to be evil. It wasn't that. It was this is what we're taught to do.
Yeah. The other thing is more of a question. How did he respond to going through the fact that he was overlapped and so forth in the portfolio? How did he take the news?
Totally humble.
Cool.
I mean, good. And I think a lot of it is a setup. So when we started the conversation, I said, hey, look, I'm going to show you some things, and I am going to tell you it's not your fault.
Right.
It is not because you are dumb, because you are clearly not. You're incredibly intelligent. Yeah. The reality of it is that a lot of times people, and this is something I talked about on Channel 5, I think. Matter of fact, Ben and I were talking about this. I said, people will not sue the industry because typically they're so embarrassed by what they've done and what they've fallen for, they won't do that. And I said, so do not put this on yourself. It is great that you're sitting in here and going through this process and just recognizing I don't know everything.
Yeah.
And that there's no shame to not knowing everything. Ignorance isn't bad.
Right.
Ignorance is I'm ignorant in physics. I mean,
right.
really ignorant.
It's interesting because it's always good to have a great source, but when you talked about embarrassed that they're not suing, they won't sue the industry. Was at a conference this past week, and one of the stats that came out, because we were talking about AI some and how it's going to be in the industry and how it would affect it. And I forget who did this survey. I can't remember the source, but 75% of people that go to ChatGPT for a financial question do it because they're too embarrassed to ask their advisor.
That makes
which
so
I
much
believe.
Sense. I do
but
too.
But that's a shame. It's like, hey, certainly if you're one of our clients, if you got a question, call us.
I love that.
But most people, it's not even that, hey, I'm curious. It's I feel too stupid to ask the question, and so I'll go to ChatGPT.
And that is, wow, that is right up the line with what I'm saying there.
Yeah.
They don't sue. I've seen people that definitely have grounds where, and now I'm starting to see stuff on index annuities and lawsuits on that. And I'm like, it's about time. But people do. They get embarrassed because they feel like I fell for something. And, why do they get embarrassed? When you think about it, some of these products promise high returns with little or no risk. And you think, now, if I admit that I fell for this,
right,
then I am seen as greedy. And, the reality of it is that it's
or like, unintelligent.
Oh, yeah, right. Who doesn't, unintelligent. But I think about that Phil Donahue and oh gosh, Milton Friedman. Yeah, Milton Friedman. I thought of it at the same time. It's like when Phil Donahue is, he's trying to defend socialism,
right,
and trying to push socialism. Milton Friedman is like, and he says, "Oh, we need to, it's greedy." Well, Are you not greedy? I mean, isn't there everybody there's a fatal flaw. Everyone falls short. The reality of it.
I've heard that somewhere.
And that is. It is written in some good book. So anyway, that's it's interesting.
That's
we do.
Good.
And
that's a good story.
And we want to actually recognize that people are ignorant. We're all ignorant and just in different areas. You're a lot smarter than I am in many areas that I would have no clue about. No, don't even think that. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, we're back here. This is the Investor Coaching Show. Paul Winkler, Evan Barner, talking money and investing. So, remember we talked about tariffs a little bit.
Yeah.
What else you got on that? Because I had something else on it.
Well, just some interesting data. I was in a presentation with Dr. Marlena Lee, who is a VP of research for a large fund company.
Okay.
And the subject of tariffs came up in her discussion.
Okay.
And, tracking, it went down in April when the tariffs came and market rebounded.
Right.
Well, we had all this conversation about, tariffs are going to ruin this and that. And it was interesting. Our three biggest trade partners, Mexico, Canada, and China, their returns in the midst of all of the tariff activity, the market returns were 56%, 36%, and 31% respectively.
I think that is fascinating because I noticed that in the data that it was just not what you would think.
Right. And
you would think they're getting hurt by this economically. Their stocks should not be going up.
Yeah.
Yeah, for sure.
So it was just, we hear this and think, tariffs are horrible. Like, well, it depends on what you're looking at. There may be an individual corporation, there may be a consumer, that is hurt by them. But in the aggregate, you really can't forecast what's going to happen on any of this.
That was so counterintuitive. I mean, it makes no sense once. Well, Jeremy Siegel, a Wharton professor, was actually on talking about tariffs this week.
Okay.
As well. And had a little segment from something that he had actually said regarding this. And
the CBO and people think that their growth estimates are too low, but the CBO came out and said the legislation, the big beautiful bill, is going to widen the deficit, but it's going to be offset by the tariff revenue. So there's some positives in terms of getting debt to GDP down based on some of the proceeds from the.
And so, of course, we're talking about if we have more spending at the government level and you have the taxes didn't go up because you had the 10 and 12% tax bracket was going to go to 15, and then you had the 22 and 24 was going to go to 25. And, you were going to have tax increases that supposedly, and they always think, are going to increase the revenue coming in. And, not necessarily because you forget about economic growth. But the CBO was putting stuff out there about economic growth going out into the future that was incredibly pessimistic. And I don't know if you remember that, Evan, but they were literally projecting forward growth in the economy at something like 1%, as I recall. I mean, it was incredibly low. Yeah, it was very, very misleading as far as that goes. So, yeah, the idea being we have a tax rates, they're going to be lower than what we thought they were going to be. And of course, you're going to start to lose revenue because there's some expenditures going out there. And can this be made up by tariffs is basically what he's talking about right there. And what Siegel said was interesting because remember, I often talk about when it comes to, people doing Roth IRA conversions. And it's funny, the investment firms were pushing Roths like crazy. And sometimes conversions make a lot of sense.
Right.
But they were pushing it because it was imminent that the tax rates were going to go up. And I was sitting there going here on the show here, don't get too excited. Find out what's going to happen before you go and start doing things based on what you think the tax rates are going to be going, where they're going in the future. But anyway, so Siegel hits something that I talk about an awful lot here and have talked about over the years.
So there could be some negatives.
There's no doubt. There's no doubt about that, and that it is. The tariffs are, tariffs are like a consumption tax. As I say, every other country in the world, a major country, has what we call value-added taxes. The United States is one of the very few that doesn't, and their value-added taxes do include tariffs.
Jeremy,
and that is something I've talked about. What if all of a sudden you've gone and converted a bunch of stuff over, paid taxes at a high rate, and then you get more thinking Trump's tariffs. He's like, we're going to make up the difference using tariffs. What if a future president decides, hey, everybody else in the world's using VATs and consumption taxes? So value-added tax, basically you buy a car, and at every step of the process of building that car, there's a tax added, and you don't have to raise income taxes. You might be able to even lower income taxes. And now you've gone and paid taxes at the old high rates just to avoid a lower rate in the future. So you just don't know, but at this point he's making it.
Was it regressive? The Democrats should love it. It's higher taxes. They love higher taxes. I don't get it. Because it's regressive? I guess because it's regressive.
Because Trump initiated them.
Wow, because it's Trump.
There's the real truth, right? Siegel just kind of hit the nail on the head with that one. Wharton professor Jeremy Siegel. Anyway, so funny. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors. And confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.